So you're still watching JEPH Kafka TV. We got one subscriber today, and we are really grateful for you. And as we always say, we'll keep on making new videos every week and improving them, even if only for you. So asante sana. And I want to go to the second or the last part of the video, where we compare the investments that we have discussed. And as I said at the beginning, this is for information, education purposes only. You do not make your financial decisions based on what I'll say or based on my opinion, but you should in fact contact a certified funds manager, certified financial consultant to be able to guide you in your investment decisions. The worst thing that I can do is present this thing about investment as if it's all rosy and good and great, because there's also the other part. People lose money. People lose entire life savings doing legit investments. So it can go either way. So what people try to do is, one, maintain what you call a portfolio. A portfolio is a combination of the different investments that are there. What happens in a portfolio is that it follows the saying, don't put all your eggs in one basket. That if one basket falls and the eggs crack, at least you have some other eggs in other baskets. So if maybe real estate or stocks are doing bad, at least you have something else that is doing good and bringing you cash flows. So one thing is to have a portfolio. Second thing, do not use emotions when you're doing financial kind of transactions, because one of the reasons why people invest is because of what they read and what they hear from their friends, and mostly those feel good stories. Friends will come with, oh, I invested this amount of money in this and this, and within 6 months I had gotten this. So that feel good. And something else we call FOMO, the fear of missing out, will make you to use your emotions instead of doing due diligence to make an investment that might end up in tears, or in some cases, if the loss was big, what they call premium tears. Now, I remember a certain time as a newbie in investment. Now, the first thing you do is you open a CDS account, and then you start looking around for shares and stocks that you can afford to buy. And being an established investor and a newbie, there's a big difference. The established investors doesn't keep on looking at the portfolio every day. But as a newbie, I was there on the phone every day, looking at the changes in prices. And because of that fear of missing out, there was a certain stock that people were buying a lot. And I ended up spending a lot of money buying that stock. And my mind again was that it will continue to grow. It will continue to gain in value. And within a few months, I'll have maybe made a couple more money and I'll sell it. But instead, that is not what happened. It's like they were waiting for me to buy, because the moment I bought, the next day, the stock lost a shilling. The next day, it lost another one. The next day, another one. And within no time, the stock had lost so much that even if I had sold the stock, or rather the stock that I had in my CDS account, I couldn't even recover a quarter of what I had invested. And that was in a matter of weeks. I wasn't conned. It was not an illegitimate business. I was just investing as a newbie, but following my emotions and not following expert advice. So I'm saying that so that you can be able to, not use just your emotions, but use intelligent advice. So we look at the investment, the potential returns, the risks, and liquidity. Already we know what an investment is. Potential returns, we know what that is. Risks, we know what it is. Liquidity is what we haven't explained so far, but simply the easiness. How quickly can you convert that investment into cash? So if you look at land, the potential returns, we see that in the short term, it's low. Before land appreciates, it takes a lot of time. Our grandfathers, those who bought plots in Kiambu in the 70s, when they were buying at, would call them now today throwaway prices. But right now, the plots in Kiambu and such other prime areas, most people cannot afford to buy them because they have appreciated by, a percentage that, from the 70s up to now. But because it has taken long time. So if your investment is in land, you can also try to do it, not just for you, but even for your kids. Places where land is cheap today. But in 20, 30 years from now, your kids or grandkids can be able to make something out of it, because in the long term, the potential returns in land are always high. The biggest risk in land is fraud, and we've seen that in many cases on TV and elsewhere, where land companies are formed and they also sell land to you, but instead of giving you genuine title deeds, they give you fake ones, or they give you something they call share certificates, which you can't be able to use to claim that parcel of land, because in most cases, more than one person will have the share certificate to the same parcel of land. Fraud is one of the major risks. And then the other risk is land. Most people buy it for speculation, but before land appreciates in value, we said it takes a lot of time. Liquidity, we know, is low. If you have an emergency today and you have a piece of land, between the date that you announce that you want to sell it and the day that you actually get cash in your account might be a very long time. So the liquidity in terms of land is low. I know people who during the mid 2010s, there was a boom. A lot of land companies, a lot of circles, Akina Ekeza and Gakuyo, selling land right, left, and center. And a lot of professionals bought land. And I know a couple of them who are stuck with idle land that they cannot dispose. Reason being, the easiness to liquidify it is very low. So that's what I can say about land. Then there's real estate. Again, it follows the same kind of rule. In the short term, the returns are low. Look at it this way. You spend 30 million shillings to build an apartment with 10 units. Each unit gives you rent of 20,000 shillings. So 200,000 shillings per month, that would be about 2.4 million in a year. So 2.4 million in a year, and you spend 30 million to invest, is a very small return. So most people might look at, if I'm making apartments and I get that kind of return, I'd rather not. But in the long run, you'll have recouped your payment, and it's an investment that doesn't require daily inputs. So again, in the short term, looks bad. In the long term, it's a nice investment. But the biggest risk is high capital. To make an apartment, you don't require little money. And then the market cycles. There are people right now who've built apartments, who've built malls, who've built stalls for businesses, but they are empty because the dynamics of the market keep on changing. You find that the facilities that make people go to a certain area, if they change, people also move from that area. With the invention of internet marketing, people have stopped renting out physical shops. So if your real estate project is in building physical shops and offices, that might be a very big risk for you. Again, the ease with which you can make it go back to cash, I wouldn't say it's low, but it's moderate. At least people would want to buy finished product, like a finished apartment. Then stocks and stock exchange. We said the potential returns are between 5 to 15%. Sometimes you get abnormal returns, but very few cases. And the returns are in form of dividends and capital gains. And the risks, the biggest is market volatility. And that is explained this way, that you can never defeat the market, because as an investor, you never have perfect information. You only react to information that is already available to everyone in the public. For instance, if Safaricom makes a profit, the announcement has to be made first so that you can decide whether you're going to buy the share or to sell the share. So you're reacting to information that's already in the market, because people are rational. If the company is not doing well, everyone will want to dispose their stock. So everyone will be selling, no one will be buying, so the prices will go even lower. The only way you can have information before everyone else is if you're an insider. But if you are an insider, you know that Safaricom is about to make a loss and you go and sell all your shares. So if you use information that is not available in the market, you're doing something illegal called insider trading. So market volatility, and then again we said expertise. Right now we have a lot of people talking about shares, investments, this, that. Please listen to your pastor when he talks about salvation. Listen to your Baba guy when he talks about football. Listen to your friend when he talks about the latest model of the car. Listen to your mechanic when he tells you about how to change your bushes and all that. But don't listen to them when they're talking about investments, because that is not the area of expertise. But we tend to get our information and guidance from the wrong spaces. So that's another risk. But the good thing is that the liquidity is high. If you have a CDS account, you have shares, you want to sell them, I think you just have to wait for a few days, maybe 72 hours maximum, and you'll have converted your investment into cash. Especially bonds, again, we said in terms of risk, they are deemed as risk-free, ranging from 9% to 12.5%, sometimes 14%. Again, the liquidity is high. In most books of accounts for big corporations that buy this, they call it cash and cash equivalents. That for an organization, for a big corporation, for someone who holds or who transacts a lot of money, remember that aspect, we said that cash loses value very fast. If you hold money for even 1 month, there's something we call the opportunity cost. You lose the percentage of interest that money would have earned if it had been converted into a treasury bond or into a marketable security. So that's something else for another day. Again, the risks, we said it's risk-free. Then here we bring in the chamas and SACCOs. So we said the one thing to determine where you're investing your money, especially in a chama or a SACCO, is you need to know the kind of returns that you will get, what they do behind the scenes so that they can be able to create or to generate that return for you. But the biggest risk is poor management, that most chamas will fail, not because they didn't have a good saving system, but poor management. You might find that the directors misuse the money, or something happens and you end up losing your money. So again, if it is managed well, the liquidity is very high. If it is managed poorly, you've seen people come from diaspora, they go to a circle that they had been investing their money with, and they're told, pesa ilienda. And the last one is business. We've already talked about business because the biggest question was, should you invest in business or land? And here we'll add one thing. There are people called angel investors who invest in either startups with high potential or businesses that are already doing well. So if your business is already doing well, both on a spreadsheet and in reality, but you lack capital, there are those people, or rather, if you're an angel investor, you have money, you can look for businesses that are already doing well and invest in them. So at the end of the day, you become a partner or a co-director, and you can have a share of the profits. So again, biggest risk is management, and that's the reason why we started this channel, to teach basic management for businesses that have started, to avoid these risks where we said that there's an 80% failure rate for new businesses. Liquidity, depending on the cash flow, and assuming that the business is good. If you're an angel investor and you've invested in a business, recently we talked about Elon Musk. He started 2 companies. His one was called Zip2. So he exited by selling it. So the high exit returns were very nice. He started PayPal. Again, he exited by selling it. And most of Silicon Valley startups end up exiting their businesses and selling them at very high rates. That's why angel investors want to invest in such startups so that they become part of the beneficiaries when business is exiting. Now, there you have it. Land, real estate, stocks, bonds, chamas, business, or how will your portfolio look like? This has been JephKafka TV. Please like, share, and don't forget to subscribe. Until the next episode, see you then.
Welcome to the unveiling of untold history documentaries, mastering classes in business management, and sparking insights through money dialogues. This is JephKafka TV, where you discover untold business histories, master the art of management, and ignite money conversations that matter.